Hi, everyone. Trevor here from Cherry Hill Private Wealth. Thanks for joining us today. One of the biggest questions I've been hearing from my clients lately is that are we heading to recession or are we not? What's going on with the economy? Markets are hitting all-time highs. The media is still talking about slowdowns, and the economic data isn't necessarily black or white. So I'm really excited to have Dave Wahl here from ClearBridge Investments. He's a director and senior client portfolio specialist. I really want to get into one of his specialties, which is the anatomy of recession. And I think this is really timely right now. It's a go-to framework for a lot of institutional investors looking to understand where we are in the economic cycle. So today we're going to hit on, where recession risks stand today, why the market is pushing higher despite all the noise, how tariffs, labor data, and the U.S. election might shape the back half of 2025 and into 2026. And then maybe a little bit of a look into where the smart money might be going for opportunities in the U.S. internationally. So Dave, thanks for being here. Before we dive in, I just want to remind everybody that's listening to this that this is not intended for investment purposes. This is for information only. If you want to see any of these strategies or topics and how they can fit into your financial plan, please reach out to myself, someone on my team, or your advisor to discuss these topics. So Dave, let's dive in.
Well, sure. And happy to be here. And I hope this is helpful for your constituents and your clients as we go forward. What we talk about is a recession risk dashboard. And what we're trying to do is we take the 12 variables that have historically foreshadowed a looming recession. And it really gives us an indication on where the economic environment is in the US now, where we think that's going to go in the future, and how that's going to affect capital markets and investing in general. So it's a green light analogy for us. Green expansion, yellow caution, red is recessionary or a slowing environment. And currently we're solidly green. 8 of our 12 variables are green, 2 yellow, 2 red, which puts us in a probability, Trevor, of maybe 70% expansionary with a 30% chance of a recession. That varies sometimes. If we'd spoken 2 months ago, we would have probably been a tinge higher on that. But right now we're 70-30. Still feeling really good about the expansionary environment in the U.S.
Yeah, it seems a little bit different than what a lot of Canadians are feeling. There was a couple polls recently. One that I just saw today from Research Co. It shows 62% of Canadians rate the economic conditions as poor or very poor. There was something earlier this week from basically said, very, very similar, where I think it had dropped actually from people rating themselves as good or very good from the last one in June. So it's kind of interesting how sentiment is one thing, and then the economic data is something else. So, even though the areas, I think job sentiment, new orders are the two that are red and look a little bit rough right now. So how do clients make sense of, that they keep hearing recession, yet like the dashboard shows, it might not have all the indications of being in a recession or heading that way?
Yeah, and when we do on a quarter, those are all great points. And now we're into like an hour session on just that one question. So I'll try to keep it brief, Trevor. But, job sentiment is red. You're right. In our dashboard, new orders are red. New orders is really like that short-term outlook from a business perspective, which, as you know, we're looking for certainty. And especially in the U.S. with policy of the administration, there hasn't been much certainty. We, in fact, thought that we would have clarity by this time after Liberation Day in April. We thought now we would have clarity around tariffs. What are people going to pay? What is Canada going to pay? And we haven't got there yet. And because of that, new orders are down, and they're signaling red. Job sentiment again is talking about how good I feel about my job and my job prospects. If I lost my job, could I find a new one? And that's kind of red. The ironic thing about it is, Trevor, is that consumer sentiment at least doesn't translate into consumer spending. So it doesn't have that correlation as you would feel when consumer sentiment is low. The consumer isn't spending as much. In the US, in fact, consumer sentiment is at very low levels, but action is speaking louder than the words or the sentiment. And consumer spending continues to increase and continues to move forward in a robust way in the US, which is a driver of some of the GDP in the US and why we feel partially good about that side of the economic sector anyways.
And I guess that's why it's so tough to predict recessions, because humans are very complex. I don't feel good about what's going on and spend it. Yet I'm still going to go buy that new iPhone, or I'm still going to spend money in all these different ways. Feelings and actions don't necessarily line up all the time.
No, they really don't. And it's counterintuitive to what we would think.
Yeah. And I think one of the things I'd like to touch on early here, and what actually is a recession? I think a lot of people, when we look at, hear the word recession or hear the word GDP and a lot of these different phrases that I think, you and I have a pretty good understanding of, and we hear the markets going up. And what is a recession? What are you actually looking at and trying to get a handle on with through the dashboard and some of these other tools you're using?
Definition, but underneath, there's a lot of things going on that make that definition maybe not quite so accurate all the time. And that's why we use that dashboard to try to get a feel for all the variables that are going on and not just GDP growth. If you look in the US just before Liberation Day as an example of how GDP can be skewed, when all the businesses were ramping up and really stockpiling inventory and doing imports before tariffs came into vogue, GDP was negative in the US for the first quarter of last year. That isn't a true indication of the economic activity that was going on in the next quarter, because imports don't count towards GDP and economic production in the country. So the next quarter, when things normalized a little bit, we had GDP growth again pretty substantially. So there's a lot of variables that we try to dig down into and get rid of some of the variables that are seasonal or some of the variables that are government spending that can come and go, to try to get a better indication of where we think the economic environment is going, either expanding or slowing.
And is this used mostly from yours and your team's perspective to get a handle on investing in markets and the next steps, or like what does this data tell you at the end of the day, or tell your team?
What this tells us is what's going on in the economic environment, what we can expect. We dig down a little bit to figure out what's going on in the labor market truly, what's going on as far as tariffs are concerned, especially in the last couple of quarters. We dig down to understand where are we in the economic environment. And then from a historical basis, we overlay that to understand what might be happening in the markets, in the capital markets, and what maybe we could find as investable opportunities at the time.
Sounds like an easy task, especially around the tariffs and some of these predictions. You did mention something there about some of the things that are seasonal, and we've seen that job creations have clearly slowed over the last little while. There's been a bit of a pickup in layoffs. Is this something that's that summer seasonal piece, or is it part of a normal cycle, or is it something maybe a little more concerning?
Well, a lot of people listen, and when you hear the word seasonally adjusted, I mean, that's a smoothing out effect that it doesn't probably really tell you what's going on an absolute basis. So we took a look as jobless claims were spiking a little bit in the summer months, and we tried to say, is that a normalized environment for the last 3 or 4 years? And it turns out that it has been. So there is usually a bump in the summer, and then there's a little bit of layoffs in the summer, and then there's a rehiring process that goes along in the September and after the back to school time happens. This has been interesting because at the end of our June 30th, when we put our presentation together, it was following that pattern. And as we move forward through the summer, it did follow the pattern. Interestingly enough, Trevor, there was a little hook, a hockey stick hook, that just had a little bit extra in the jobless claims and a little bit ramp up in jobless claims. So we looked at that and we say it's maybe a little bit of a concern. And I think the overall labor market has really been the impetus and the driver for the Fed to cut interest rates, similar to the way Canada did, maybe different reasons. But in the US, it was about the labor environment, and that was probably the impetus to cut rates, not inflation. Doesn't mean inflation's beat and that's not a priority, but labor had become an increasing concern to Jerome Powell and his group.
And are you looking at different areas of the labor market specifically, or is it a general outlook? Consumer spending, like where does this kind of go, or what are you looking at specifically?
Yeah, well, it's a good question, and our canary in the coal mine is jobless claims. So if you're speaking to our dashboard and the red, yellow, green, if that jobless claims turns red, it's currently green. If it turns red, that's kind of our canary in the coal mine. It's our heaviest weighting in our index and how we build our consensus. If that goes red, then we're probably feeling that is going to be a recession and us turning to a recession. That hasn't happened, and that was even when we were really high on a recessionary indication, that didn't never turn red. So that's a real good indicator that as long as that's green, we're fairly positive. But from a labor perspective, one of the things that we look at right now is U.S. job creation. And on a quarterly basis, your listeners have probably heard 100,000 plus per quarter is the number in the U.S. Once you get below that, that's a red flag. And that's saying, we're in a labor slowdown. This is concerning. This might mean a slowdown is coming. But we look at it now, Trevor, and we see that might not be the case. We might not be in an era anymore where 100,000 plus jobs being created is the norm. In fact, if you look at some of the consensus that's gone on in Bloomberg's consensus is that for the third and fourth quarter this year, it will be under that number on a job creation perspective. And if you look at the revision that just happened, a very large revision that the United States put out, there was a revision of 900,000 less jobs created. And so that brought down the average number of jobs created to in the high 50s or 60,000 range. And in fact, they had a negative job creation month in June for the first time in a very long time. That is concerning. And again, led to the cut in interest rates. But the new norm is probably somewhere in that 50, 75 range. So it won't be creating 100,000 jobs every quarter. It might be something less. And that has to do with deportations in the U.S., less immigration in the U.S., government jobs not being created, but actually being cut, as we've seen. The Supreme Court said that the Trump administration was within their right to cut all those government jobs. So that'll be a little bit of a drag as well. So a lot of things going into it. We just think it's maybe a new norm for the next little while around job creation.
And how do you talked about the revisions, and it seems like there's been a lot of revisions and typically, in one direction over the last little while. How do you guys account for that? Or is that something that you do account for in the initial data that you're looking at?
Yeah, you don't. You expect revisions, and normally on the downturn, part of that is because the initial data and collecting of the data is very hard. It's very hard to get people and companies to push that data. You see payroll reports, that's probably a little bit wonkier than other data, and it takes a while to get it. And once they get the yearly or the annual data and can collect it, it normally goes to revisions. And 900,000 is a big revision downward. There have been big revisions downward in the past, so it's not truly out of the realm, but it got a little more spotlight as we saw the leader of the statistical group in the U.S. lose her job over unfavorable numbers.
Yeah.
Because they weren't accurate, but unfavorable numbers.
There you go. Yeah.
Yeah.
Kind of going away from the job side of things, I think we spent a lot of time on there, and I think with what you just said,
it's a good topic.
Yeah, it definitely, and it's such an interesting massive topic. The other piece that I want to look at a little bit is core GDP, and I think there's again, this massive bucket. It's changed a lot in the last little while and what we look at and different things or what you look at specifically. And then I just read the reports afterwards. But, we've got, thank you for that, by the way.
It's easier to do it.
Yeah, exactly. So core GDP is sitting around 1.9%, which is lower than the average from the last 22 to 24. Is that a sign that we're cooling gently, this soft landing piece that we've heard a lot about the last little while, or is there something more concerning, or is this just not a big deal?
Yeah, another good question. And the core GDP that we had sent to you, the number that we're using, just so that everybody's clear, we always talk about core inflation. We talk about core, all these core numbers so that we get to really to the bottom of it. And we talked a little bit about that in the jobless claim spike. We wanted to find out what's really going on. So from a core GDP perspective, we took a look at real final sales to private domestic purchasers. So what are consumers buying? And is that continuing to be a driver? Because in the US, the consumer does a lot of driving of GDP growth. So we stripped out things that, like you said, the buckets get changed, and the buckets, you can use other buckets to strike other numbers. But we took out inventories and trade. We took out government spending, which isn't as relevant to equity markets. And what we did was we found that currently those sales to the domestic purchaser is lower than it has been over the last few years, but it's not extreme low. It's 1.9, as you mentioned. The average is about 2.6. We're comfortable that there's still growth being driven by the domestic consumer. So we're not as concerned that growth is slowing tremendously, but it has slowed. So again, something to be cognizant of going forward.
Jump into the one that's probably the easiest for you to predict: tariffs.
Yeah. Well, I think
the thing that's in the headlines, I think more than anything right now from an investor standpoint, we see this a lot. They're getting back to those levels that we haven't seen since the 1930s. That's not a headline we hear often. Like that's a long, almost 100 years at this point in time. How big a drag can that be on growth over the next year or forward, especially while companies try to figure out what this new reality is in the unpredictable world that we are in, especially around tariffs right now?
Well, listen, Trevor, I'm not going to lie. Tariffs, they're scary because of the non-clarity. There's no clarity around what's going to be the end game of tariffs. So you spoke about it. I mean, tariffs average between 2.5% and 4% over the last 40, 50 years. They currently are up in the 18 to 19% an effective tariff rate on the US. And you would think that that would start to roll through the economy and slow the economy down, or perhaps be inflationary. So far, it hasn't. And is it going to be? We think so. But, Goldman Sachs did a study where they said, why is this happening? And why haven't we seen increase in prices, a slowdown then in consumption and then a slowdown in growth? Why haven't we seen that yet? And it's really because Goldman's study said currently 40% of tariffs are borne by the exporter, the person or the company bringing the goods into the US. 40% are still borne by the importer. So 80% of any tariff are still being borne by the exporter, importer. The consumer's getting about 20% of that. And it's starting to trickle down. Well, now we just recently saw some information that said import prices or imports are starting to push a little bit on prices. There was about a 0.3% increase. So we might be at the beginning of that. Tariffs now are going to probably start to do what everyone thought they would do and raise prices and perhaps, increase inflation. If that happens, I think it's going to be tough. The small business in the US drives a lot of the economic environment, and it really drives a lot of the job openings in the US. As those small businesses, and they're, by the way, tariff takers, they can't go to the president's Oval Office like Tim Cook for Apple did and present something that might get them out of tariffs. They're pure tariff takers. So a lot of them are bound by that. A lot of them are concerned about hiring new people. They're concerned, can I keep the people that I have? And if we get into a slowdown, will I start to see, a few layoffs again? And that could be, something that you should look at as we go forward with an 18% tariff in the US right now. Truthfully, we thought that this would be done by now. We thought that clarity would happen. Us as Canadians would have clarity on what's going to happen between Canada, Mexico, and the US. I think the US businesses as well, they're waiting to make business investment. Their business investment is down. Canada's is certainly down. Our exports to the US are down because of tariffs. We thought that clarity would have happened by now. And as you know, Trevor, the market hates nothing more than no clarity. So once we get this settled, and I think we will, and we get clarity back into the capital markets, I think that'll be good for all of us, and investors included.
Yeah, and it's interesting because markets hate uncertainty. We saw that initially with the Liberation Day and kind of the turmoil we saw directly after that. But it's kind of stabilized. I mean, the markets are still performing well even with this uncertainty, and I wonder if it's partially due to the fact that we're not taking this threat as seriously as we did initially, or we think it's just going to be kicked down, or is it just is there a different reason for it from what you're seeing?
Well, a couple of things, and I don't think I answered the final part of your question about the effect of tariffs and the drag on the economic environment. And the estimates are wide and broad in the next 10 years. The estimate is probably about $3.8 trillion drag on or tariffs collected, which will be a drag on the economic activity. The big bill, or as people in listening might have known, it's called the One Big Beautiful Bill. We'll just call it the big bill for now. It has a huge fiscal impulse for next year. So there is a lot of stimulus that's coming from that bill once it gets enacted, and it has been enacted now. So next year, about 1% of GDP is estimated to, be felt because of this fiscal impulse. So if you take the effect of tariffs and the big bill is about a 2.8 trillion stimulus to the economic environment, tariffs aren't going to be as big a drag as possible as we thought originally. So, that I think gives some comfort to the markets. Most of the stimulus will be next year. And it's interesting that there's midterms next year in the US from an election perspective. So we'll see how the economic environment behaves because of that. But a lot of it's coming there. And then it fades a little bit over the next 3 or 4 years. What's going on in the market? I just read a study of portfolio managers investing in the S&P 500, and 68% of them believe that the market's overvalued. But almost all of them also are committing more dollars to the market. And you're a good advisor, and you've been around for a long time, and when you get to that kind of frothiness and that fear of missing out, and you get away from a little bit on valuations, it becomes time to take a look at what you're investing in, and maybe you can broaden out your investments or do something different. Because right now, the concentration levels in the S&P 500 are at historic highs. They're at 40% concentration. And for your listeners, that means what we're measuring is there's 500 names in the S&P 500. The top 10 names account for 40% of the capital weight on in that index. When it gets to that level, Trevor, you start to see the next 5 years, the equal weighted, which means the more broader, not just the hyperscalers, the very largest mega caps that we all hear, the Mag 7 style names. When you get to that level, history shows the next 5 years are very good for the equal weighted index, which means you can take on smaller names. You can take mid cap names that are still very large names in the US market, and it's very large in Canada if you compare it to here. But those are the ones that historically, when you see that concentration, they do better. So the markets are, yes, they're highly valued, but is there opportunities? There probably are going forward.
Yeah, and that's where I was going to get to kind of next here is that you do have those 10 names that are doing a lot of the heavy lifting, and there has been that quiet shift to value and dividend stocks starting to show up a little bit here, and you think this is more the trend as opposed to a blip, because we did see a little bit of a cyclical change earlier in this year or late last year, which didn't seem to stick around very, very long. Is this more of a blip, or is this something that could potentially stick a little bit longer?
We think that we think it'll stick. We think that we are historically in the markets. And again, like I said at the beginning, Trevor, we try to see what went on historically so that you can get a perspective, not from the short term, but what has normally happened in similar times in history. And if you look at the markets, there's 10 or 20 year mark or times when the market is growing, followed by 10 years of a flat market or slightly negative, followed by 10 or 15 of a growing market. And that's been over history. Right now, we think we're in year 15 of a 20-year bull market. That's historically what we think we're in. And a couple of years ago, Trevor, what would we have said is going to drive that? Well, we would have talked about productivity and, continued earnings per share growth, et cetera. But right now, it's probably that AI talk. And we haven't said much about AI, but the spend has been terrific and tremendous. And if we get some monetization around AI, if we get a broadening out of the advantages to AI, so it's not just about the hyperscalers, but it can broaden out to those other businesses, they can take advantage of productivity increase, et cetera. We think that's going to be the driver of the next 5 years. So not a blip. And I mean, leadership can change as well. We've had US leadership for a long time. Leadership is usually, or not usually, but it is correlated to the strength of the US dollar. If you believe that the US dollar over the long period of time is going to be on a secular downturn, which we do, that means it's probably a good chance to get involved in international investing, emerging markets. As you go up the risk curve, emerging markets do best when there's a weakening US dollar. Ironically, the S&P 500 does better whether it's weak or not. So abandon your US, that's where you maybe broaden out on market cap. But there's a good chance. The markets this year, and a little bit of a blip in the slowdown in the US market, it is because historically, when you get a downturn in the market of about 20%, which we had in 2022, and then you start to see an upturn again, historically, you have a third year that's a little choppy. And we're getting that. But this year as well was the United States earnings per share growth was much lower than most other regions in the world. So that's another impetus to why the US maybe didn't perform as well. And actually the Canadian market, up until Monday, and things change rapidly, has outperformed the US market this year, which is good news, partly because it's good news on valuations, and Canada's traditionally more value tuned market. So there's lots of opportunities. I don't think it's a blip. I think we'll continue to go up, but there are opportunities outside the US. You don't have to be, glued to the mega caps. I don't think, Trevor. It's a good chance.
Yeah, I think we forget about a lot of these great international companies that we could be putting some money into, and really focus on the U.S. There is something that's maybe a little bit sexier about the Apples and the Nvidias, and some of those massive companies that are really driving the S&P 500. But there's a lot of great value outside of the U.S. markets, and like you said, Canada, who has typically been an underperformer, in comparison to the U.S., has performed really, really well, especially with those big dividend paying stocks, which is great for the retirees and people that are looking to take some money out for sure.
And in times of market volatility or uncertainty, as you know, Trevor, dividend growers are a great spot to be. They're quality names. They can kind of stem the tide of that uncertainty. You can still get a payout as you go along, and usually they outperform the market on the downside. So yeah, it's a good point as well.
Yeah, and kind of get into that, where I think there's still a lot of money sitting on the sidelines in money market funds and these types of investments. I think a lot of people are still really nervous. You were talking about sentiments not necessarily aligning with consumer spend. But when it comes to investments, I find that sentiment does a lot of times line up with how people invest their money or don't. What's it going to take to unlock some of this cash and get it moving again? Do you think it is that consumer sentiment that needs to change?
Well, maybe, but if you look at consumer confidence, and when it's at a very big low, and we think we had a big low in May of this year, and so far that's turned out as we track it going forward. When you get those periods, and again, it comes down to making picks and getting advice. I truly mean this, Trevor, getting advice so that you are able to make the right decision without emotion. So traditionally, if consumer confidence is low, that usually means that people aren't putting money to work. And that usually means the market's at a downturn. If you would have had, the ability or the wherewithal to put your money to work, then you get outsized performance. At all these lows, these very big lows in consumer confidence in the U.S., if you would have invested then, the S&P goes up 25% in the next 12 months on a historical average. So I hope that people get their money off the sidelines. I think there's a few things that are going to happen likely. A lot of people are looking for safety and have looked for safety in GICs. They've paid a pretty good rate, Trevor. I'm sure that you've seen that in the last little while, that people are willing to go to a GIC paying 5.5% or 6% with very little risk. Tax consequences might not be the same, but very little risk. As that starts to ratchet down, and we saw the beginning of a downturn in short-term rates in both the U.S. and Canada, I think that might be a time when people say, yeah, I'm not taking on any risk, but I'm certainly not getting any return. And inflation is still out there. I think that could be an impetus. I think that cuts in rates, as you know, is positive for the markets, especially on the mid to smaller cap names in the US and Canada. When you get that kind of cut and stimulus in the environment, I think that's a good time to invest as well. I certainly hope people do, because when I started doing this conversation with this presentation, it was 2020. There was $4 trillion on cash on the sidelines, and we couldn't believe how big that was. Now we're at about 7.5 trillion and growing. So, when that money starts to trickle in, doesn't have to come in waves, but when it starts to trickle in, it'll be a positive for the markets as well.
Yeah, I hate some of these sayings that investors like to have, but you missed a couple of these great days, and it can really have a massive impact. And if we're waiting for it to pull back before we invest, it could pull back. That's fine. It might pull back 10% or 20% or whatever the markets do, and this happens quite often. But you can miss a lot of that run up and still be in a worse place, even trying to catch it at the perfect time, as opposed to just making sure that your money is invested in doing the right thing. Well diversified, like we're kind of talking about earlier. I think having that kind of mindset makes a lot of sense.
A longer term horizon, which is really hard in this environment that we're in now. Everybody can get by the minute ticks on their names that they're looking at on a bank stock, etc. The information overload is crazy. So that 5-year time horizon that I'm sure we're hoping everybody can work on kind of gets, skewed to the sidelines. And that makes it very difficult to get those returns because I'm sure that you and I and most people on here could say, I think the market might be on a downturn. I'm going to get out. But gosh, it's hard to get that timing to get back in.
Yeah.
So that's the key. It's a 2 trade out and then back in. So
yeah, time it out on both sides and getting that perfect.
Yeah.
There's a reason why when you look at the top investors on Wall Street each year, it's a different name. Some people can get lucky and be pretty good, but yeah, time in both sides is really difficult.
And all your gang on listening to this presentation, they'll hear of Warren Buffett, and he is the king of buy and hold, quality companies. So.
Exactly. Talking about consumer confidence being low, but you've shown that's a pretty solid contraindicator to equities. Does this actually set up a better opportunity than people think?
The consumer confidence?
That's right. Yeah,
it does. I spoke about it a little bit earlier. It's really been a contra indicator for equity investors, and that makes sense. If consumer confidence is low and people are willing to get into the market during probably a volatile or slowdown in the market, or maybe even a downturn in the market, they traditionally can do much better. The trick is to be able to make that investment at that time because emotions come to play. And after that dip, and in history, we've seen, from our graphs, we've seen, I think, 10 or 11 or 12 of the biggest downturns and troughs in consumer confidence. We measured the S&P after that, and it's been up 25%, 12 months after that from the major troughs. So yeah, consumer confidence, consumer sentiment, they're contraindicators on spending and consumer confidence on where the market is going to go in the next 12 months.
Okay.
But it's hard to do. You and I both know it, right? I know there's times when I said, gee, I should have invested at that time and I didn't. So that's why you need really good advice, and I have buddies that try to give me good advice, but I don't always listen. I'm shameful.
Yeah, and it is tough with your own money, right? Because you kind of mentioned that it is money is emotional, and having this kind of conversation with you where we're not talking about the emotional, we're talking about what's actually going on.
Yep.
As opposed to I don't like Trump, or I don't like his policies, or I don't like the way that this feels. As opposed to here's what the data is actually showing us, and this is historically what would happen in these types of situations. From that very, I don't want to say removed, but a little bit less emotional, because we're just looking at the numbers and making the best decisions, for ourselves and for our clients, without that emotion.
Well, emotion aside, and some of the things that people don't maybe like from a presentation, or sometimes a humanity perspective, sometimes not. It depends. But some of Donald Trump's policies are bang on, and they're good for investing, and they're good for the economic environment. They might not, you hear a lot of political noise, but a lot of these policies are not going to hurt the U.S. economic environment. In fact, we think as we're at 70-30 on if we're going to have a recession or not, we think we're in an expansionary environment. If you just went by how you feel or your emotions, you might not think that. You're right. It's a bang on comment.
Yeah, we get lost in the noise, and I think that's part of the problem is, right. We get that emotional thing, and as opposed to just looking at that raw data.
Yeah.
And speaking about raw data, there's been a lot of talk about debt levels, kind of either on a per person basis or a governmental side of things, interest costs, and what interest costs in the government as part of the GDP, and things like this. But your data hasn't shown that the debt has necessarily pushed yields higher at this point in time. So, like, what do investors need to understand about this kind of disconnect at this point?
Well, it's a great question, and there is no correlation. So if you look at it, one of the concerns is that as the debt grows, the yields on your 10-year government bonds are going to increase. You take the example of Japan and the United States, there's so many other variables that are going on. Japan's gross debt as a percentage of GDP is probably double the United States. It's close. It's somewhere in that range. And if you look at the yield on the Japanese 10-year, it's under 1.5, where the US is just over 4. So there isn't really any correlation around that. So, there's other forces, of course, that make a difference when it comes to bond yields, but debt doesn't seem to have that direct correlation.
Okay, interesting. Okay.
Yeah, it is interesting.
I've got a couple bonus rapid fire questions if you're okay with that, or is there anything else you want to touch on before we get into the hot seat here?
I just think that there are a lot of opportunities on the investment side. We've talked about other things, Trevor. When we have geopolitical risk, the market usually dips, but it's a very short dip. Or when you have very large rallies, and traditionally geopolitical risk, we've looked at it over since 1950, so 70, 80 years. And if you invest in a geopolitical risk and don't shy away, you usually do okay 3, 6, and 12 months out. So that's a good thing. If you invest after there's been a major rally in the markets, usually strength begets strength. So it's not a time to shy away. It's a time to take advantage of a continuation of that. And you have the opportunity to get outperformance. And in fact, we just had a very big 50-day rally in the last 3 months to the middle of June or so after Liberation Day. And traditionally and historically, those top fastest 50-day rallies, and this one fits in the top 10, it's number 10. Usually after that, the S&P performs very well. In fact, it outperforms. So there are lots of opportunities to invest. I think you made the comment, and maybe not directly, but being in the market is better than not in the market, regardless of when or regardless of the economic environment that we're currently in.
Yeah, that's a great point, because I think a lot of people, and from a one company or one stock kind of perspective, a year ago or 2 years ago, people were talking about Nvidia being too expensive now and kind of shied away from it. Had you invested with that, or you could almost name any of these companies that have had good rallies, people have kind of shied away because now they missed it, but you can kind of take that rally.
It doesn't go into perpetuity, as we all know. Yeah. I think we sent you some information on the top 10 names in 2000, and where are they now?
Yeah.
So it changes, and that's why you need advice. You need people that can, take a step back. And even the winners of last year, they're not all the same winners this year. So there is opportunities for advice, stock picking, making decisions, but don't be afraid of markets improving to be a reason why you don't get into the market, because you miss on that upside, and it takes a long time to recover.
Absolutely, and that's a good lesson for diversification, and not necessarily putting it all into that hot stock, because like you said, they're not always the same the year after. So
they're not.
That's great. All right, rapid fire.
Yeah. I'm a little nervous on this one, but
we're gonna stay in your lane. We're gonna stay in your lane. And it's going to be a few that we've kind of touched on a little bit here as well. So U.S. equities or international, if you had $1,000 to invest right now, where are you putting it?
New money, I would divide it, and I would put the majority of that money in international right now.
Okay, great. Private credit and private equity are having a moment. Do they still make sense in this type of environment?
It's a good question. I don't do a lot of work around the private side. I know that that's kind of all the rave right now. And I think there's opportunities to get good private credit or good private equity. But I still think that the listed markets can get you meaningful returns for the investor like myself, who's just an average investor. And I have almost all of my money in the listed markets.
Perfect. What's the biggest risk on your radar right now? What keeps you up at night?
I think tariffs. I think tariff uncertainty is still out there. That's the big wild card. And you had mentioned earlier, the market hates uncertainty. We need some clarity. We need some ways to be able to make investment decisions from not just from a market perspective, but from a business perspective or buying a home perspective if you're Canadian. So that keeps me up at night. I think we need clarity, and we need the USMCA to be done and then move forward.
And last one, what are you most optimistic about for the rest of 2025 and into 2026?
From a sector perspective, from a place perspective, from a market perspective, or just whatever I want?
Whatever you want. Dealer's choice.
Yeah, listen, you know what? I feel like, we are in frothy markets, and I think that's good for Canada. And I know that there's a lot of negative sentiment around Canada. I think, you hear that investments down, exports to the US are down. I think this is a really good chance for us to have to make decisions that we might not have made in the past. And if markets come back to valuations that matter, not just that fear of missing out, I think, Trevor, Canada's got great opportunity, that core quality Canadian names. You spoke about the dividend side. I think Canada for me, can be an opportunity to outperform going forward. And I think from an economic perspective, we'll get better news going forward. We'll get some clarity. And I think Canada has lots of opportunities.
Love it. Love it. So Dave, thank you. I think this was exactly what my clients and our listeners were looking for. Like we kind of talked about, it's so easy to get caught up in the headlines, but having that deeper understanding of what the data is actually really saying can really change how we invest and how we plan and how we think about risk and opportunity. So for those of you watching, if you have any questions about how this applies to you and your portfolio, or how we're positioning client assets through these cycles, reach out anytime, whether it's your public investments, your financial plan, private strategies like real estate and credit. This is what we do. And of course, if you know somebody who is trying to make sense of these markets, feel free to share this with them. So Dave, thank you again so much. This was wonderful.
Great. Yeah, I think, and I hope that it was meaningful in some way to your listeners, and it helps them feel better about what you're trying to work with them on. So thank you.
Thank you.